Good afternoon everyone, or good morning to those of you joining us in the West. My name is Nick Carne. I'm a member of the National Board of Wine Communicators of Australia, and it's my pleasure to welcome you to today's webinar, Wine Equalisation Tax, Are You at Risk? This session is a partnership between WCA and Finlaysons lawyers, an Adelaide-based but very much nationally focused law firm with a strong and long-standing wine law section. Many of you would probably know Will Taylor, who heads the team and has been taking the annual Finlaysons Wine Roadshow around the country for more than 20 years. Today, however, it's two of Will's colleagues, Michael Butler and Mathew Brittingham from the firm's Tax and Revenue Group, who will be running proceedings. The idea for today's webinar came from Finlaysons because they say they are still seeing not only a lot of confusion in the industry about wet and the wet rebate, but also many people falling into traps that could be avoided, and they can be very costly traps. Now, I have to say today is not for the faint-hearted. The wet rebate is a frustratingly complex beast, and Michael and Mathew can't avoid digging down into that complexity if they're going to give you the advice you need. I should point out that copies of the PowerPoint presentation will be available to you, all of you, after the webinar. I should also make the point that this session is not about the politics of the wet and the broader issue of how wine should be taxed. It's about the reality of the system that we have and what wine producers need to know and to do. Now, if you're new to webinars, and I think we do have some first-timers certainly to WCA webinars with us, it's important to know that there is scope for you to have your say and to ask questions as we go along. We'll get to as many of these as we can during the session, and if we don't get to yours, we'll try to get back to you after the session. You can comment or ask questions in three ways. Use the discussion box at the bottom left-hand corner of your screen, which works in much the same way as sending an email. Type in your message, hit return, and it will then appear in the box and will be visible to everybody who's taking part in the webinar. Alternatively, you can use Twitter or simply email Jen Barwick, WCA's Program Manager, who's here in Finlaysons Adelaide offices with Mathew, Michael and I. The details for Twitter and email are on your screen, so please join in. And so, to the action. Michael, perhaps you could start with an overview of the journey you'll be taking us on today.
Thank you, Nick. Going here. Yes, we thought it would be useful to start the session today by providing an overview of the topics we propose discussing this afternoon. First of all, we'd like to, as Nick said, look at the origins of the wet rebate and the journey to today to what is certainly, we think, a real mess. We're going to then look at some fairly technical points. These are raised in the outline which has been circulated to everyone. We're going to look at some specific areas where the ATO is focusing. We're going to look, for a start, at the grouping of associated producers, which is very important. Look at that in some detail. We're going to then look at the new blending rules that were introduced in December 2012. We're then going to examine uncommercial or collusive arrangements which a number of taxpayers have apparently entered into to increase the amounts of rebates they get. For example, we're going to look at growers who become wine producers and look at certain blending arrangements where multiple rebates are claimed. We're also going to look at some practical problems where people claim rebates on the incorrect price. What is the price which you can actually calculate and get back your wet rebate? We're also going to look at the difficulties that arise accounting for earlier rebates on bottled and fortified wine. Importantly, from a practical issue, we're going to look at what you need to do if you receive an ATO audit notification letter. And we've certainly seen a number of our clients, a frighteningly high number of clients, receive these letters over the last 6 to 12 months. What should you do there as a practical matter? And the point we're going to make is you can't just ignore these letters because you think, well, I haven't done anything wrong. I'm honest, so I've got nothing to fear. You have to respond to them and you have to take them very, very seriously. And we'll talk about that in a bit more detail later on this afternoon. And the final point we want to make right from the outset is that the wet rebate affects all producers, big and small. And we've seen a number of small operations, husband and wife operations, who are being audited and where the tax office is potentially claiming that a significantly large amount of wet rebate is something that everybody has to take really seriously and in many cases get professional assistance.
Yes, so going to the start and the origin of Wine Equalisation Tax. So prior to GST, wine was subject to a 41% wholesale tax, which was abolished when GST was introduced in 2000. And basically to ensure that wine prices remain stable, people wouldn't drink too much, and probably importantly from the tax office point of view, to maintain the revenue collected from wine, a Wine Equalisation Tax was imposed on the last wholesale sale. So effectively the wet 29% plus 10% GST equated to roughly the 41% wholesale tax that existed previously. So the actual wet rebate, well, that came in because for the Liberal government to get the GST legislation through the Senate, they needed to appease the Democrats, and they had to offer a 14% rebate on cellar door and mail order sales. And that applied in conjunction with the 15% state cellar door subsidy. So if you held a state liquor licence, cellar door and mail order sales up to $300,000 per annum were wet free. And this was, the government said, primarily done to assist small winemakers and to promote tourism in regional Australia through increased cellar doors. So in October 2004, the cellar door scheme was replaced by the current producer system, where a 29% rebate was applied to the wholesale value of wine sold. And this allowed producers, regardless of whether you made cellar door sales or not, to get a $290,000 per annum rebate, and there was no requirement of a state liquor licence, and it extended to cider, perry and sake. And the government considered that 90% of wine producers could fully offset their wet liability, and again, that 85% of the benefits of the rebate would go to small producers. So you can see the theme coming through as to why this legislation was enacted. The second expansion of the wet rebate occurred on 1 July 2005, when it was extended to New Zealand producers who export wine to Australia, and on 1 July 2006, a year later, it was increased to $500,000 per annum.
Guys, this is probably an appropriate time to ask the obvious question as to why the New Zealand has got it. I know there's still a lot of misunderstanding out in the industry, not to mention angst, about why we have to give essentially our competitors the money back. But also I was asked the other day whether, with the government looking for more and more FTAs with various countries, whether there's a risk that we could find similar provisions falling in place with other countries.
Right, well, it was had to be done to satisfy Australia's international law obligations under the 1983 trade agreement with New Zealand. Whether it be happening with other trade agreements is probably unlikely. It was specific to that particular trade agreement.
Right, so the good news is probably a one-off, the bad news is we seem to be stuck with it.
Well, I think we've seen recently with the Chinese, Korean and Japanese trade agreements have taken a number of rounds of negotiation. I think if Australia started offering wet rebate to other countries, producers in Chile, for example, I think there'd be a fair bit of complaining and representations from the local populace here.
Taken as read. Thank you, Mark.
So why the strong focus on wet rebate claims with the tax office? Well, Treasury figures show that the wet rebate paid increased from 60 million in 2004-05 to 280 million in 12-13 and is projected to go above 300 million. And the tax office considers that this is partly due to the emergence of virtual producers being able to claim rebates through blending, and that they actually, as we'll come to see, haven't been curtailed by the blending rules which came in December 2012.
Michael, that's a fair bit of change since the scheme came in. From a tax lawyer as opposed to an industry person's perspective, how do you see that, the transition process? But more importantly, if the government could wind the clock back to 2000, do you think they would have done it differently?
I think if they could wind the clock back to 2000, there's an enormous amount they'd do differently right across the board. Specifically in relation to wet, though, I think they probably would leave it as it was for the first 4 years, from 2000 through to 2004, where it definitely aimed at supporting cellar door sales and supporting local regional industries and tourism and the like. I think the problem started in 2004 when they extended it to all producers, and they took away the need to have, for example, a state liquor licence.
Which leads us nicely into what WCA proposed in December.
Right. As you mentioned, late last December, WCA released its own action plan. One of the issues it dealt with, of course, was the wet rebate. What WCA noted, and I think is obviously fairly self-evident, is that the rebate remains a really important amount of income for a number of small winemakers who are struggling with both the difficulties of the decline in export sales and the problems there, and the intense competition in the domestic market. Everybody's fighting out for themselves. And the WCA also noted that without the rebate, a significant number of wine businesses would probably be severely impacted financially. We've certainly seen that. And a point which I'm sure strikes a chord with a number of people listening today is the fact that whether originally intended or not, the rebate has effectively been factored into business models and pricing strategies at all points in the supply chain. That's obviously a very difficult point. So WCA has some proposals. Some may agree, some may not. Basically, what WCA is saying is that they think the wet rebate should be removed from bulk, unpackaged and unbranded wine, that is anything in containers over 25 litres, which is a pretty big flag, isn't it, Nick? It should be removed from wine. It should be removed from wine for private labels for retailers, and also from wine that's not a finished product that's fit for retail sale. They're obviously looking at wanting to restrict the rebate simply to finished wine being sold by a specific retailer. And that comes up in the next point, that they think the rebate should be limited to those producers who actually manufacture and sell wine in a form which is packaged ready for retail sale, and where the finished product is identifiably theirs. So you can see what they're really trying to restrict it to. Or alternatively, to those who grow grapes and sell wine in a form which again is packaged ready for retail sale and is their wine. I think what they want to do is to get back to the early 2000s and make it a regional rebate.
Great, so that's the scheme as we have it. Let's turn to what the AT is on.
Okay, now we get to the hard stuff. As we'll see on the next few slides, the ATO is taking a very serious approach towards attacking wet rebate schemes, and it's got three main weapons in its armoury. We'll look at these in each in a bit of detail, but first of all, it's got the so-called associated producer provisions. And what we'll see here is that under these provisions, closely affiliated or aligned producers who are acting in concert or under the control of others must share a single $500,000 rebate cap each year. So if you have two or more associated producers, then they only get to share one rebate and not one each. We'll look at that in a bit more detail in just a moment. Secondly, there are the new blending rules which were introduced in December 2012, and they basically reduced the rebate by amounts of rebates that have been claimed by previous suppliers in the wine production chain. And finally, the big black dog, the big missile in the Commissioner's armoury, are the general anti-avoidance provisions contained in Division 165 of the GST Act, which are specifically incorporated into the WEB Act. You've got those three main weapons. And we'll now look at those in a bit more detail. And under the Division 165 general anti-avoidance rules, they just knock out rebates in their entirety. It's a very, very, very strict provision, causes a lot of angst. Looking first at the associated producer provisions, the point here is that a group of associated producers is, as I mentioned, only entitled to a single annual $500,000 rebate. So they can sell, I think it's on sales of $1.7 million, they'll get a rebate of $500,000. But if they go above that amount of annual sales, they only get $500,000 rebate amongst the entire group of associated producers. And what we've seen in recent audits is the Commissioner arguing not just that 2 or 3 parties are associated producers, but in some cases 5, 6, 10 people are associated producers. And importantly, and this is the practical issue, if you have associated producers and they have each been separately claiming the $500,000 rebate each in their own right, and they are audited, they are potentially going to have to pay back significant amounts of rebate, plus penalties, plus interest, perhaps going back 2 or 3, even more years. We're seeing that as a real concern and a real problem for a number of associated, or a number of wine manufacturers. Now, you can be associated in 2 main ways. There are what we call 2 limbs. First of all, the bright line test, which I'll look at in just a moment, and then there's the acting in concert, or the control limb, which Mathew will discuss in just a moment. First, look at the bright line test. What this says is that under this first limb, producers are associated if one of the producers and its affiliates, and I'll look at what affiliates are in just a moment, controls the other. So one producer and its affiliate controls another producer, or both are controlled by a third entity. So you've got a tree of entities. What is an affiliate then? An affiliate is an individual or a company, although not a trust, and that's quite important, often overlooked. So an affiliate is an individual or company which acts in accordance with, or acts in accordance with the directions, wishes of, or in concert with the producer in relation to their business affairs. So what you've got is a very technical rule there. It's just saying an affiliate is someone who acts effectively at the same time in accordance with the wishes of some other party. Now what then is now that you've identified what an affiliate is, what is control? Well, under the bright line test, one entity will control another entity if, in the case of a company, the entity has shares carrying 40% or more of the voting rights. So if you hold 40% of the shares which have voting rights, just straight off, you will control that company and you will be an associated producer. Alternatively, if you have a unit trust and one entity owns units with a right to 40% or more of the income or the capital, then again, that entity will control the unit trust. And finally, if you have a discretionary trust, one entity will control that discretionary trust if it's received 40% or more of the income or the capital distributed by that trust in any one or more of the previous 4 years. It's a very, very wide test. Or alternatively, and it gets wider, the trustee of the trust acts in accordance with the directions of another entity. That often comes up as a matter of practice, where under a standard trust deed, you have an appointor provision, and the instigator of the trust, often the father or the mother or the grandparent, has the right to replace the trustee. That person automatically becomes the controller of the trust. So to break it up and just looking at a quick diagram, perhaps read this a bit later tonight, Nick, when you're sitting in bed, drinking your cocoa, wrap a towel around your head, work through these diagrams. What we've got here is producer a company A, which owns 40% of the shares in company B, and company B has received a distribution from a trust, which is also a producer, of 50% of the income 3 years ago. In that case, because the discretionary trust has paid 50% of its income to company B controls the trust. Because company A owns 40% of the shares in company B, company A controls company A controls company B, and because you've got this line of entities, company A in turn is also treated as controlling company the discretionary trust. And as a result, all 3 of those entities are a group, and all 3 will only be entitled to one single $500,000 producer rebate.
Michael, as we move away from that slide, it's a good time to remind everybody that we will be emailing copies of these slides to everybody participating in the webinar later this week. They can print them off and have them to read, as you said, in bed. While we're there, can I just ask you a quick question? Melanie asked, how aggressive has the ATO been in defining associated? She makes the point that this industry is pretty interconnected.
We're going to talk about this very shortly, and what you'll find out is the ATO is extremely aggressive. And they, as Mathew will describe in just a moment, there's a case which is very, very much in the Commissioner's favour, and he is looking at this very, very closely and is well aware of the fact that the industry is very, very interconnected.
Mathew, the second limb.
Yes, the second limb. This will give rise to producers being associated if one acts in accordance with the directions, instructions, or wishes of the other in relation to its financial affairs. The concept will come to in a sec. And this provision was considered recently and for the first time in the Administrative Appeals Tribunal in the S.J. Butler decision. So let's have a look at this case, because this outlines the ATO's approach to this. And the tribunal in that case held that financial affairs in the context of wet legislation means important wine producing activities. So you'll be associated if you act in concert with or at the directions or wishes of another producer in relation to your important wine producing activities. And in the Butler decision, AAT held that S.J. Butler, which was a company that was recently established by the wife of one of the owners of a well-established family winemaking company called R.L. Butler and Son, which was established to make wine, was an associated producer of R.L. Butler. And the factors that the tribunal looked at to show that S.J. Butler acted under R.L. Butler's instructions in relation to its wine producing activities was that R.L. Butler sourced grapes and negotiated the price and quantity on behalf of the wine's company, arranged for transport of those grapes to its processing facility. It processed those grapes into wine in accordance with its own specifications, and S.J. Butler engaged R.L. Butler to package the wine. In addition, S.J. Butler only sold the wine to R.L. Butler, and importantly, it sold that wine at a loss, so the tribunal considered that it did that to pass the benefit of the wet rebate to R.L. Butler. And S.J. Butler was virtually a shelf-type company, didn't have any advertising or its own website, and it sold the wine under R.L. Butler's brand and didn't have any employees. And some other factors which counted against the taxpayer in that case was that R.L. Butler actually incurred processing charges in excess of the grapes that went over the weighbridge, and S.J. Butler didn't charge any interest for late payments.
So what's the message in that Butler case? It sounds fairly aggressive, as Michael was suggesting.
But I think the clear message there is now the Commissioner has a clear precedent which he can use to attack or against other taxpayers, and the Commissioner is certainly confident that he has a win on the board and is certainly utilising that leverage.
So we can possibly expect more of the same?
Yes.
Depressing news.
Yes, and just very quickly, some other factors which the Commissioner might look at which weren't discussed in R.L. Butler on the screen, such as same client base, accountants, etc. But there are probably two important ones there, is that if you have interconnected financial arrangements, you could be in trouble, and also if you have other business relationships, like a distributor business with another producer, then the tax office may look to tackle you under the associated producer provisions. So the other important thing that people don't always pick up on with these provisions is that you can't rely on your current position to determine whether or not you were associated in previous income years. So you have to test the actual facts that existed at 30 June in each year the rebate is claimed. So just because you're okay now doesn't necessarily mean you were okay in the past. That's an important point.
The final point to note there is that we've been approached by a number of clients over the years to ask us whether they can set up separate entities which can trade as separate producers and claim separate rebates. And I think the view we've always given them is they have to be completely separate, no relationship at all. And as you've just seen from these points that Mathew's raised and from the criteria that the tribunal applied in the S.J. Butler case, the ATO is on the warpath, and it's not enough to say, oh, we're acting independently.
The question's just been asked, and I think I interpreted it correctly, whether in the Butler case it was a genuine scam or a simple scam, or were they simply unaware of the rules?
here?
Well, that's not an excuse. I mean, it was relatively blatant that they were associated producers, whether it was a scam or such, is what didn't need to be ruled on, was the Division 165, the anti-avoidance rules, which sort of deal with scams. Wasn't decided on in that case. It was purely on the associated producer provisions.
Could it be done out of ignorance? Just look at the question. I think the point there is that I think if people are setting up, I mean, in this case, clearly the wife of one of the owners of RL Butler set up their own separate company. They obviously did that because they wished to gain access to a second $500,000 rebate. The question is how closely did they look into it? Did they really do their homework? And I think it could be argued they perhaps didn't. Okay, moving on to the associated provisions to the associated producer provisions to the new blending rules that apply from the 10th of December 2012. These rules were introduced from that date, and what they're basically aimed at doing is reducing the rebates on blended wine, where earlier rebates have been claimed on the wine that's used to make the blend. This will be a bit clear when we look at some diagrams in just a moment, but what the tax office is basically saying is if you've claimed, if you've made wine, you've claimed rebate with respect to that wine, and then it's mixed with another wine where rebates have also been claimed, you can't double up or even triple dip and get further rebates. The big question though is, do the rules work? The rules clearly are designed to protect the integrity of the producer rebate, which is tax office speak for avoiding double counting. But they, as we'll see in just a moment, we don't think they necessarily cover all inappropriate claims, and hence what we think is the debacle that's currently going on with Division 165. And also, again, as we'll look at in just a moment, gives rise to some real difficulties in relation to record keeping. So just looking at the actual minutiae of the rules, the new rules reduce the rebate that a producer can claim when that producer uses wine acquired from third parties in that producer's blend. So if he gets if he has his own wine and he mixes someone else's wine into it, or he separately, and some people have done this, he acquires 2 or 3 separate parcels of wine and then uses that to create a completely new blend. The rebate that a producer can claim is reduced by the sum of the so-called earlier producer rebates. And that figure, that expression, earlier producer rebates, is the amount of producer rebate that the supplier notifies the blender that they have already claimed on the wine they have supplied. So you've got to give your supplier has to give you a notice saying how much rebate he's actually claimed on the parcel he sells to you. Or if no notification is provided, then the amount the supplier could have claimed on the wine they had supplied if they weren't subject to the $500,000 cap. Importantly, if no earlier producer rebate, there's no earlier producer rebate if the supplier notifies the blender that they are not entitled to claim the rebate on the wine supplied. So if the producer says, I'm not entitled to claim it, then there's no earlier producer rebate. And such notification will occur where a supplier has maxed out on the $500,000 cap for a year. So we'll see in just a moment how this gives rise to a fairly curious result. We think it's actually effectively a loophole in the legislation. Mathew will demonstrate that with an example in just a moment. Finally, there's some fairly important notification requirements. Record keeping is always a hard issue for all clients. The notification has to be given by email, letter, or added to the tax invoice. It's got to contain the usual factors you'd expect to see: the ABN of the supplier and the recipient, the description of the wine, including the quantity and price, the date the wine was supplied, and the tax invoice number. Just a whole lot of stuff, and it seems like an administrative nightmare to just keep on complying with. But you've got to do it, or else you face real problems.
And do you often find people falling down essentially on the paperwork?
Unfortunately, we do, because people are often dealing with people they've dealt with for a long time. They trust them. They know what's being supplied to them. They just see this as an unfortunate administrative hassle. Unfortunately, from the 10th of December 2012, you've got to comply or you're not going to get your rebates. And in addition, it's a strict liability offence. That is, you don't have to prove, it doesn't matter what you thought or it's just what you did. If a notification is false or misleading, and you can be misleading by a statement or omission. So all notifications need to be checked carefully. You've got to have a process in place and not just do it when the tax office comes knocking on the door.
Okay, so let's have a look at an example of how these new blending rules work. We've got producer A here, which sells 100,000 litres of wine and claims an earlier rebate of $29,000. We've got producer B, who we assume has maxed out their $500,000 cap for the year, and they give a notification, as Michael was just talking about, to producer C, saying that they're not entitled to claim an earlier producer rebate on that wine. So then producer C blends that wine to their producer and become entitled to the wet rebates, and they sell it at wholesale for $300,000. So prior to the introduction of the blending rules in December 2012, producer C would have been entitled to a rebate of $87,000, being 29% of the $300,000 price they sold that bulk wine for. However, now with the new blending rules, they're going to have to reduce that by the $29,000 of earlier rebate claimed by producer A. So in effect, they will only be able to claim a $58,000 rebate. So that's the operation at a basic level, but the apparent operation of these new blending rules, when you look at a bit more complicated or a longer supply chain, is that producer C, in this case, would be required to reduce the rebate that they claim on when they on-sell the wine by the earlier rebate claimed by producer A. So in this very short example here, you've got producer A who's claimed the $29,000 rebate of sold wine to producer B, who's blended it, and then, but obviously they've maxed out and then on-sold it with the notification they couldn't claim an early producer rebate. So you'd think at first sight with the rules, producer C would have to reduce the rebate they claim by $29,000.
That would certainly seem to be the intention.
Yes. However, at last we've got some good news to report today, which is the fact that the reduction is actually only limited to one link in the supply chain. So if we tease out the example from a couple of slides ago where you have producer A who sold wine and claimed the rebate, and producer B who claimed no rebate and notified producer C, they blended it and sold it, if you recall, for $300,000, and they claimed a $58,000 rebate reduced by the $29,000 claimed by producer A. To producer D, who uses creates 20,000 litres of wine from its own grapes, blends it so it becomes a producer, and then on-sells it. So what they have to do is they only have to reduce by that one link back in the supply chain. They only have to reduce the rebate they claim by $58,000 and not by the earlier producer rebates throughout the whole supply chain. So that is a bit of a boon or a bit of a win for taxpayers out of this new legislation.
And before Mathew goes on, it's actually been confirmed to us by the tax office.
Yes, I presented this in a joint presentation last November with the Assistant Commissioner, two Assistant Commissioners actually, and they fully supported that reading of the legislation.
But you're suggesting not clearly that well known in the industry?
No.
But the tax office will attempt to do it a different way, and that's why they've got the audit action, which we'll be discussing in just a moment. But as it stands, they introduced these rules to deal with multiple blendings and multiple claims of rebates, but their own rules don't work.
That probably doesn't surprise a lot of people.
Strange rule.
But if we have a look at another issue that's been raised, a very practical issue by sale. And there's been a lot of complaints by producers who manufacture bottled wine or fortified wine. This is very onerous, and that there's no accounting systems currently available to assist them in that regard. And I've been to a number of meetings at the tax office starting about a year ago, and there's been a lot of discussion about this practical point. And as we said, it's also bad for fortified wine producers, as they'll need to keep records longer than the 5 years they've been accustomed to evidence early producer rebates. And sometimes it can be unnecessary, because at the point of manufacture you won't often know if you're going to sell it domestically or export it. So if you go through all this tracking, it can be done for nothing if the wine is ultimately exported. So after a year of, as I said, of negotiations with the tax office, they have issued a consultation paper at the end of January this year, and what they suggest is that one possible solution would be for them to exercise their power under the Act to enter into an agreement with affected producers as to how they'll calculate wet rebates, and perhaps come up with a more simplified model, such as an approximation of earlier rebates per bottled wine. But this is still in consultation at the moment, so nothing has been defined or completely reached. But even if they do go down that track, they'll be under no obligation to enter into such arrangements, so it'll be on a piecemeal and case-by-case basis.
Okay. There's a couple of questions, that we can go back to them on the examples you've just run through. One from Sandy asks, this model seems to discriminate against producer A. In effect, their wine costs more, and suggests this is likely to favour the larger wine companies.
Yes, we've certainly seen anecdotal evidence that a lot of purchasers will be looking for the notifications that no earlier producer rebate has been claimed.
Okay. And another question from David. This example assumes, I presume he's talking to the most recent example you did, this example assumes producer C doesn't quote wet exemption. What happens if producer C pays wet on its purchase? I've got Mathew going back to his slide now.
If we're talking about slide 29, 31, is it?
Yes.
Okay, yeah.
It might be one we have to get back to David on.
Well, no, because in that one it wouldn't be the last wholesale sale, so assuming that producer D would quote.
Right, okay.
So they're a producer, they're going to see the wholesale sale is shifted down the track.
Okay, good. Thank you.
The practical issue which we see is that people quote, or they say it's a wet-free supplier, but they don't actually provide the quotation form.
Okay.
Just a practical problem we've seen.
Paperwork.
Yeah, a paperwork problem. Simply that. Okay, but now I'd like to look at the Commissioner's position in relation to what we've referred to as uncommercial and collusive wet schemes. And what the starting point for these is the fact that blending rules don't seem to in some cases, prevent a number of the schemes the Commission was trying to prevent. What we've seen, and what the Commission has obviously seen, is a number of wet rebate schemes which involve a producer who's effectively maxed out on the rebate early in the year. They've done their $1.7 million of sales, and they've reclaimed $500,000 of wet rebate, effectively establishing or encouraging other people to establish virtual producers to produce wine on their behalf, and in that way access further rebates. So other parties are inserted into the chain to become producers, even though those producers are so-called don't themselves have a winery or don't have winemaking machinery and equipment. They undertake the contractual risks, but they're not actually a real winemaker in the literal sense. And the new rules introduced in December 2012 don't really provide a mechanism for dealing with that type of mischief. Because the blender can claim a full rebate if they've received notification that the supplier is not entitled to claim the rebate, this is the point Mathew was looking at just a moment ago, the new rules effectively encourage the behaviour they are meant to prevent. Because effectively, if someone has used up the whole rebate and they give the relevant notice saying they're not entitled to claim a rebate, then the person who purchases from them can take the wine and blend it and claim an extra rebate, which is exactly the thing which the rules were intended at least to prevent. Okay, so as a result, the ATO deals with these problems by relying on its big black dog, Division 165. And certainly last October, a number of you will be aware that the ATO issued a taxation alert. The ATO taxation alert is where the ATO comes out and says, we're aware of stuff going on in the industry, we'd like to stop it, and we're just letting you know that we're aware of what's going on, and we will in due course issue formal rulings and provide further advice about what we're going to do. And this ruling, issued last October, considered what the ATO considered to be two contrived arrangements to access additional wet rebates. And we believe this is a very, very clear signal to the industry. The ATO plans to target these arrangements by applying on the general anti-avoidance rules in Division 165, which, if they are applied, have very significant penalties attached to them, in some cases 50%, even more. Then on 11th of December 2013, a couple of months later, the ATO issued a draft wet ruling which confirmed the ATO would in fact apply Division 165 to these arrangements, which were highlighted in the tax alert. And then late last week, that draft ruling was put into final form. So it's now there. It's something the tax office has got. Their policy is certainly the way they're going to apply the law. As I mentioned, there are two types of arrangements the ATO is targeting. The first arrangement, which I'll look at, is where a producer interposes an entity to make wine. In this case, an interposed entity is established, a new company or a third party buys grapes from someone the wine producer previously or normally would have purchased the grapes from. So instead of the wine producer buying the grapes from the usual grape seller, they put an interposed entity into the chain. Then the wine producer manufactures the interposed entity's grapes into wine using the same specification it uses with its own wine. And then the wine is sold by the interposed entity to the wine producer, who then sells it to a third party, who is in fact the person that the wine producer would normally have sold the wine. We'll look at this in a diagram in just a moment. What happens is you interpose an entity into the chain. The interposed entity adds nothing of commercial substance. The ultimate purchaser in the chain acquires the same wine it would have received if the interposed entity hadn't been involved. All that you've done is you've put in a new party, a new company, a new virtual wine producer, which purports to claim another $500,000 rebate. So here's a diagram for you to read in bed, and you get the PDFs from Wine Communicators the next day or so. This is the ATO's diagram, which was attached to the taxation alert. What you can see is you have the grape grower, and the wine producer is the person who ordinarily would have bought the grapes from the grape grower. But now instead, you set up a new linked entity is set up, which purchases the grapes from the grape grower, and it sells, the wine producer provides its winemaking services to the linked entity, which then sells its wine to the wine producer, which then sells the finished wine to the third party, the usual purchasers of the finished wine. What you've done here, by the simple expedient of including the linked entity, you've got an additional $500,000 rebate.
And the second arrangement is where you set up staggered sales through multiple interposed entities who blend wine. And so this arrangement involves interposing an entity to buy bulk wine from a large wine producer who's already maxed out their $500,000 per annum. They get extra wine in and it's blended by that wine producer, so they qualify as a producer and can claim the wet rebate. Then they sell that wine to another interposed entity and essentially the process is repeated until the wine is sold to the third party to whom the producer would normally sell to. So this creates extra rebates by a number of staggered sales, and all the wines made to the same specifications that the sort of main producer would do as if the scheme was not implemented. And here's the tax office diagram. You can see there's 3 interposed entities in that chain. We've actually seen ones with a significant number more interposed entities in there, so you could see why the tax office is keen to clamp down on these schemes, because this arrangement is the one that really does give rise to a large number of additional rebates being claimed on essentially the same parcel of wine.
What we're seeing is the tax office going out, using their information collection powers, identifying a number of producers who are manufacturing wine, and even though they're seemingly unrelated, the tax office preparing this diagram, some involving 8 or 10, sometimes 12 parties, and saying you are all associated producers, and therefore you're not entitled. You're only entitled to 1 rebate.
So the ATO is earning its keep.
Certainly is.
For the industry.
So the factors that they'll look at to uncover these arrangements, I won't go through all of them here, but probably the main ones here is that the interposed entity hasn't approached other producers to manufacture its wine, and it hasn't approached anyone else to sell its wine to. Basically, the whole arrangement is dictated by that large wine producer. So another arrangement, which is actually coming back into vogue at the moment, with grape prices being so low, is where a grower becomes a producer. And this was originally dealt with in Commissioner's Wine Equalisation Tax Determination 2011 number 1, and it involves basically long-term fruit supply arrangements being cancelled, and in their place a new agreement for the producer to process fruit on behalf of the grower and buy the resultant wine. So in essence, you create another rebate by creating another producer and the grower. However, what we're actually seeing at the moment is a number of grape growers who are actually being forced to become producers as a matter of commercial necessity, because if they don't have buyers for their grapes, so if they don't turn the grapes into wine, they'll just rot on the vine or on the ground. So we see this as a very big issue going forward, and one we would say to watch this space on. And what the Commissioner will look at in these arrangements is, we've just discussed, they enter into a contract to buy the wine soon after agreeing to process it. There's no commercial rationale for entering into the fruit supply arrangement, so that where the tension exists, when there is a commercial rationale, when you can't sell the grapes, that'll be something that we'll see a bit of to and fro on, we think. Here's the main one that the tax office looks at, is that the rebate is shared by the grower selling the wine at a sub-market price, and that's probably the key factor to consider there.
And have we had any hints from the tax office on how it feels about the grower becoming a producer in general?
The initial feeling is that they probably don't like it, but it's probably something that they're still trying to understand, given the current market conditions.
So it is a watch this space.
Yeah.
I think that that's the point, that there's often a very real commercial driver for a grape grower becoming a producer, because long-standing contracts have been cancelled because they're not renewed. And from the tax office's viewpoint, they're just seeing a wine grower becoming a producer and claiming a rebate. And that leads on to our next slide, that in a number of these cases, they're getting back what our clients are receiving, and their tax agents are receiving audit notification offers, letters from the ATO. And these are things you need to act on. Although you may think that there's a commercial rationale for what you've done, that may not be the same way the ATO views it. If you are audited by the ATO and they reassess you and claim back the rebate, your potential penalty could be as high as 25% of the wheat you've previously claimed. So you've not only got to pay back possibly $500,000 for a couple of years, or perhaps some smaller amount, but potentially $500,000 a year for a couple of years, plus 25% penalty, so it's another $125,000, plus the general interest charge, which is currently over 9% per annum. In addition, if the ATO seeks to apply the Division 165 anti-avoidance rules, there is at least a risk of a penalty of 50%. So these become very, very costly mistakes and very, very costly problems. However, if you make a voluntary disclosure within 1 month of receiving an audit letter, the ATO writes to you and says, we're going to commence an audit in a month's time. You might like to review your records. You might like to ask us to reassess you. If you do that and you decide to come forward and return the rebate, penalties can be reduced up to 80%, and there is some chance of reducing the general interest charge that is also imposed. The point we'd like to make, though, is that if you do get audit notification, if you get it directly, which happens in some cases, or if your tax agent or accountant gets it, you need to seek legal advice urgently. You need to have a tax lawyer examine the situation quickly and before the voluntary disclosure period expires. You can't just say, well, we've done nothing wrong. We've got a commercial rationale for doing this. You've got to go back to the tax office and explain it to them. And that often can't be done just over by the way of a phone call. And thus, in the words of the great Kenny Rogers,
you've got to know when to hold them, know when to fold them, know when to walk away, and know when to run.
And you should have sung that.
I don't think we have Kenny Rogers quoted quite enough in our webinars. Guys, we've got a few minutes to go. There's a couple of other brief issues you wanted to touch on, I think. Sales to distributors.
Yes, very briefly. This is another issue which we see often pull up with the tax office, is that on what price wine is sold for. So trade discounts and volume rebates reduce the price at which wine is sold. However, the Commissioner has rulings which say that promotional rebates that compensate the distributor for advertising and expenditure incurred do not reduce the price at which the wine is sold. However, in practice, the ATO takes a very strict stance on what constitutes a promotional rebate, and they generally require specific evidence that the rebate you've paid has a direct advertising or marketing expense associated with it. So the mere fact that you have a distributor conduct advertising or marketing on your behalf may not be enough for it to come within a promotional rebate. And we are seeing a lot of arguments with the tax office in this regard currently.
And often with small producers, we've seen some very small operations, they're not claiming a $500,000 rebate, but they're losing tens of thousands, and it's a significant amount. Okay, and the final slide about commission agents. Another point is that a fee which you pay to a commission agent who sells your wine as your agent doesn't reduce the price at which the wine is sold, but it doesn't reduce the amount in which you calculate rebate. And so if you're not currently maxing out your $500,000 rebate, you may need to consider adopting the commission agent model in favour of the distributor model to ensure you can claim maximum rebates. Just to give you a simple example on that, it may be better to sell a dozen bottles of wine for $100, less a 25% commission, and claim a rebate on $100 than to sell to a distributor for $75 and only claim a rebate on $75. Okay, so we can conclude. We think there's some important takeaway points which really need to be taken into account. This is clearly a complex area for everyone, big and small. It's not just the large producers, no, it's for everyone, the SMEs, also the small husband and wife operators. And it's an area we're seeing the ATO examining very closely and very, very widely. And it's coming as a huge shock to a number of producers. As you've seen, there are numerous areas where you really can get into strife and costly strife. You can have problems under the associated producer provisions, not just because you enter into an SJ4 type arrangement, because you're doing other deals with other producers. The ATO is aware this happens and they're looking at it closely. There are problems under the new blending rules, which really could cause us some tax nasties to arise. And there can be some real problems under the uncommercial arrangements, which the Commissioner has highlighted in his tax alerts and his taxation determinations. and also there's just some practical issues with trade and promotional discounts and commission sales, which should be taken into account because at the end of the day, every dollar counts. As we mentioned, we're seeing the Commissioner auditing broadly and widely and very, very vigorously. We think you need to get legal advice urgently. And as I mentioned right at the outset, you can't just ignore this just because you think, well, we haven't done anything wrong. We've seen a number of clients have said to us, look, what are we doing wrong? We're just doing what everybody else is doing. What we understand is common market practice. We thought we were told we were able to do what we've done. That may not be the case in the ATO's eyes. So it's something to think about when you're sitting and reading these notes in the next day or so.
Mathew, Michael, thank you. That's very valuable. One quick question without notice. We obviously get a lot of questions about the volumetric versus the wet argument. One has come through. Is there another alternative? Will we be having this same debate in 5 and 10 years about the way to tax wine, the best way to tax wine, whether a volumetric-based or a wet-style tax is correct? Wearing your tax lawyer's hat, where do you see it? They're looking at each other.
We could go offline with Benjamin for the next hour or so as we eat our lunch. It's an argument about whether it's alcohol content or volumetric. It's an argument that's been raging for years. Obviously, some favour one regime and some favour others, and some have a vested interest in it. I think that there's just such a problem with the present system. None of the two systems is a better system. I think they've just got to fix up the mess they've got with now. I don't think it's going to be a simple way of just converting, for example, to a voluntary tax.
Certainly the Henry Review, going back a few years ago, said that all alcohol should be put on a volumetric tax basis. But as we know, with sort of tax reform, it can take a number of years for these things to occur.
A future webinar, I think. Mathew, Michael, thank you very much. To everyone who joined us, I hope you found that interesting. To repeat, you'll get a copy of the slides by email later this week. The contact details for Michael and Mathew are on the screen right now, should you like to get in touch with them and follow up directly. A couple little bits of housekeeping from me. A reminder that our next webinar is on June the 3rd with the guys from Minamofo. The slide there, Design for Success, Are You at Risk, is a merging of this topic and the next topic. It should be Design for Success, website design for wineries. The date, June the 3rd, save the date, but if you want, go online and register now. Registration is already open. And finally, if I could ask you all to complete the exit survey, which will pop up on your screens as we finish. It's very quick. And those who do complete it will have the option to sign up for future Finlaysons client alerts from their wine law team. So once again, thank you, Michael. Thank you, Mathew. Thank you, Jen Barwick. Thank you to everybody for joining us for this joint webinar from Wine Communicators Australia and Finlaysons. Thanks.
Thanks, Nick.